Hello, I'm Ben Hockema, founder and advisor at Illuminate Wealth Management. Today, we're going to take a look at the Big Beautiful Bill and how it affects your taxes. I am recording this on Wednesday, July 9th. This bill was just passed late last week. And so we've had a chance to look through, see how this affects most of our clients. There's a lot of things that I'm not going to be able to cover in here. This bill is over 800, almost 900 pages long. There's a lot of nuances and things that affect different people in different ways. We're going to focus today talking mostly about personal taxes and primarily on our clients. We're talking middle class, upper middle class clients, and how the big beautiful bill will affect you whether you're working or retired. So let's jump right in. And we're going to start with just the big picture. Where are we? The Big Beautiful Bill extended most provisions in the Tax Cuts and Job Act from 2017, and this is effective here for 2025. So it is retroactive. It's for things that you've already done maybe this year will affect your taxes under this new bill. Overall, most of the provisions are the same, but there are some key differences. So the standard deduction will increase even higher for seniors. We'll talk about that in a little bit. And then the SALT tax, or state and local tax increase deduction for up to 40,000 from what was capped at 10,000. As a note, that only goes through 2029. And then we have some clarity on estate tax exemptions that we're going to revert. And also, one thing that I'm really happy about is maintaining step-up basis. And so no taxes would be due for capital gains when you pass away. That was something that was debated over the last couple of years on what would actually happen. So just some clarity on estate taxes are really helpful. As we look at the tax brackets, so before the Tax Cuts and Job Act of 2017, we started at 10%, went 15, 25, 28, 33, 35, and 39.6%. Those with the Tax Cuts and Job Act were lowered for most of them across the board, and those lower numbers are continuing now, and they are permanent under this new Big Beautiful Bill, as they're calling it. So the tax brackets are mostly the same. Let's dive into some of the provisions that are different, primarily on itemized deductions and charity. So we're going to spend the next couple slides on charity itemized deductions. First and foremost, there's a higher standard deduction. So if you do not itemize your deductions, you just want to take the standard, that is $15,750 per individual. So if you're married filing jointly, that's $31,500 is what you can deduct for standard. If you're a senior, so 65 and older, you also get an additional $6,000 per individual. So that adds up to a lot when you add it on top of the standard deduction. That's a pretty big number. Those do start to phase out though when your income's above 75,000 as a single or 150,000 joint. So that will be very important as we look at the deciding, are you taking how much you take in RMDs, required minimum distributions, or do you sell things for capital gains? When you get close to that 150 joint number, that's going to have some pretty dramatic impacts. And so tax planning around if you're close to that number in retirement is going to be a really important number to focus on. For a lot of people, especially for my clients in Illinois, which is about half of our clients, the state and local tax deduction increase of 40,000 is a big deal. It allows you to deduct property taxes, state taxes from your itemized deductions, which coupled with the standard deduction will make it really interesting as we kind of talk through when do you itemize, when do you do a standard. As a note, that does phase out for incomes above $500,000. And so for some of our clients, I'm thinking of a few clients that we are doing virtual CFO services for. Just think doctors, lawyers, making higher incomes, pay a lot in state and local taxes. What we're doing for those clients will continue to be valuable when we're doing PTE, or pass-through entity tax payments. That allows you to take a higher standard deduction and not be subject to the phase outs here for the SALT tax deduction increase. So those are all things we'll talk about if it's relevant to you as a client when we do tax projections later in the year. But just know that PTE payments are still actually very valuable as we're looking even with the SALT tax deduction increase. And then mortgage interest deduction, just as a reminder, is capped at a $750,000 loan. So if you have a loan that's higher, you can only deduct the interest related to the 750. And so that is going to add into your standard deductions. As we talk about charity, there's a couple changes here as well. So if you are taking the standard deduction, which as a reminder, those went higher, as we talked about in the previous slide, if you do not itemize, so you're taking standard, you can deduct $1,000 per individual, so $2,000 if you're married, for charitable donations. So if you think back to 2020, there was, I believe, there's a $300 above what was called above the line deduction, where even if you took a standard deduction, you could deduct for charitable donations. That is back, and it's a much bigger number. So now it's $2,000 for married filing jointly. On the flip side, if you do itemize, if you're taking itemized deductions, and so that's where the SALT limits and things like that come into play, the first 0.5% of AGI is disallowed. So similar to medical expenses, where the first 7.5% of adjusted gross income, or AGI, limits how much you can deduct, this is also happening on charitable donations. So these coupled together make some really interesting strategies, especially related to charitable, more attractive. So number one, if you are retired, you're taking required minimum distributions. Qualified charitable distributions, or QCDs, in retirement are much more favorable. And this happens primarily because we want to keep the incomes low to maintain that senior tax deduction. And because 0.5% is disallowed from the itemized deductions, there's even less of a reason to itemize and more to do with the QCD, which lowers AGI to begin with. So that's what the QCD is. And then charitable bunching can be more advantageous. That is a difficult concept to explain. So I'm going to just throw a bunch of words up, walk you through what that actually looks like. So as an example, charitable bunching is basically saying, let's take our charitable contributions we were going to make and let's bunch them for the next couple years into 1 year, get a deduction, and then take a standard the following year. So let's imagine this scenario that you and your spouse jointly earn $225,000 a year. You want to give $15,000 per year to charity, and then your other charitable, your other itemized deductions that are not charity related add up to $19,000 a year. So if you don't do bunching, if you just give $15,000 a year to charity directly to your charities, and then do everything else the same, you can itemize each year at $32,875 is how much you get to deduct off of your income. How did I come up with that number? It's $15,000 to charity, but we have to subtract off that 0.5% of AGI. So 0.5% of 225,000 is 1,125. So that comes off the top, so you don't get to deduct that amount. Plus you add back in your 19,000 in itemized deduction. So that you get just under 33,000 each year that you get to deduct. If instead you take 2 years worth of donations and you do it all in 1 year, maybe do a donor advised fund, so you still get to have some time that you can pay it out and you don't have to do it all in 1 year. You could do bunch 2 years of donations into 1 year. So instead of 15,000, you do 30,000. Still have that same 1125, 0.5% of AGI limitation. Add your 19 in, you get 47,875 that you can do in year one. And then year two, you don't have enough money to itemize. You're not going to itemize. You're going to take a standard deduction. And this assumes that you're working under 65. So the standard deduction for that couple would be 31,150. So in the first year, we are doubling up on our donations so that you can get a higher itemized deduction, and then reverting back to the standard deduction, which has a much higher floor to begin with. That leads to an additional 13,275 that you can deduct over a 2-year time period that you would not have been able to deduct if you didn't do the bunching, saving you, let's just say, 24% tax on that. So, a quarter, let's say $4,000 of tax just by changing when you pay into charities and when you do the donor advised fund, potentially in that case. So giving the same amount to charities over the same frequency, you are actually going to give it over 2 years. It just shows up on your tax return all in 1 year. That's some really big benefits just by doing a small little change as you go through. So that's an example. If it's relevant for you, we'll talk through it. If you are not a client, you've got questions, definitely reach out if you take a look at this and want to know if this applies to you. Some other items to note that changed with this bill, and again, these are not all of them. I'm not going to talk about Medicaid changes or additional defense spending. We're really focused on how does this affect individuals that would typically be our clients and watch this video. So we do have an increased child tax credit. So if you have a child, a minor child, you get even more of a tax credit that helps. In addition, there is a new $1,000 what's called Trump account, which is an investment from the U.S. Treasury when a baby is born, starting here this year. So if you've already had a baby born earlier this year, you can apply for this. There's still some question on exactly what the process will look like to get your $1,000 from the Treasury and what sort of institutions will sign up that you can actually open an account with. But long story short, you get $1,000 into this account. There's some limitations and things that you can and can't do with that, but that's a nice benefit. Also, dependent care FSA or flex spending account contribution limits are much bigger, up to $7,500. That goes for things like daycare cost and stuff like that, and so that's a great tax benefit. And then additional expansion of 529 plans, what you're able to do. So, for instance, if you're taking an SAT or ACT prep course, that you can use a 529 to help pay for things like that were not included before. Other items of note, there are some major changes to student loan repayment programs and limits on how much you can borrow for graduate school and Parent Plus loans. And so that if you do have student loans, that is a very complicated change that depending on what type of plan that you're on now, when you took the loans out, what the plans are in taking new loans, those are all major things that we're going to have to work through way outside the scope of this conversation today. But just know there are some pretty significant changes that if you have student loans that you are currently repaying anything other than just the standard repayment plan, probably need to talk about that and work through. And if you're going to borrow in 2026 or on, there are new rules that maybe if you had maybe you have a child that's in college now that you borrowed for, and you've got one in high school that you're going to pay for next year, the following year, the rules have changed when taking out new loans. So that's something to definitely look at deeper. There is a tax break that is going away, and that is for new or used electric vehicles. That ends September 30th, 2025. So if you are in the market for a new or used electric vehicle and you want to make sure you get this tax benefit, you need to have it in your possession by the end of September of this year. So get moving on it pretty quickly if you're in the market for that now. And likewise, at the end of this year, clean energy credits go away. So things like more energy efficient HVAC system or something. If you're already thinking about doing those things and you think you'd qualify for clean energy credits, those will go away by the end of this year. So this is the year you need to do it. And then the last thing of note is just the auto loan interest deduction on USA assembled vehicles. So that does not mean it's necessarily a US auto company. It actually has to be assembled here. So there will be some US based companies that do not assemble their vehicles here, and you don't get an interest deduction for those. And there could be some foreign companies that do assemble here, and you will get a deduction for. So it's going to be very make and model specific, but something to know if you are going to get a loan, you may be able to deduct the interest if it was assembled here in the US. So with all that, those are the major changes. Just wanted to spend about 15 minutes walking through what's actually happened and how the big beautiful bill affects your taxes. As always, reach out. Happy to talk to anybody, client or otherwise, just through some of these changes, what that would be. And stay tuned as we have more clarity on a few of those things as Congress finishes some touches and the IRS comes out with some additional regulations for all that. So thanks for taking the time to learn about the big, beautiful bill, and hope you have a good rest of the day.